Well, hello and welcome to Moneycontrol. I'm your host Nickey Mirchandani, and today we are going to be talking about the earning profile of Zaggle Prepaid Ocean Services. Perhaps the company which has the stock has moved significantly in the run up to the earnings. The stock is up as much as 14% after the subdued performance that we've seen post reporting their quarterly numbers. But how does the fine print actually looks like? What's the way ahead strategy and more on the financials? We're being joined by the managing director and the CEO and the co-promoter of the company, Avinash there. Afternoon there. I'm going to straight up ask you about your performance in terms of the margin guidance that you've given. The fact that it's dropped from 12.2% to 6%, essentially due to a change in the product mix. Talk us more about that. What kind of run rate can be expected? The guidance suggests a number of 11 to 13%. What are the key drivers behind that?
Good afternoon, Nickey. Thank you so much for having me on the show.
Pleasure.
So our numbers were in line with our expectations and projections. We grew very healthily in terms of our revenues. There was 34% growth in revenues. Our cash back grew up by about 39%. EBITDA was up by 27%. So overall, if you look at our numbers, the numbers have been, if you look at year on year, the growth has been healthy. And we are looking, as you rightly mentioned, at an adjusted EBITDA of about 11 to 13%. The key point here, overall, the revenue growth guidance that we've given for the year is about 40 to 50%. The key point here is to recognize that we have had to take a ESOP cost of about 5.8 crores this quarter, which was not there last year in Q1, and that has had an impact. Other than that, if you look at it, things are as we would have hoped for.
Okay, so what do you think would be the growth driver going forward for the margin profile that you're looking at? What do you think? Where would the growth essentially come from?
Nickey, growth is this space that we are in. We are in the spend management space, and there are two beautiful tailwinds that support us. Right, one is the digitization drive in the country, in the globe actually, where everybody wants to be more compliant, wants to use more platforms, technology, make it faster, simpler, easier to use for their users, employees. And then there's the fintech revolution in which India is at the forefront. So we have these two tailwinds, and if you look at it in terms of the spend management space, we are the leading player in spend management, and that helps us in terms of being able to sign up bigger contracts with banks, with networks, with corporate customers, and there is operating leverage in this business, obviously. So that's where we see a lot of scale coming in. Our latest launch of YoY, which is our accounts payable platform, is doing very well. We launched our co-branded corporate credit card with Yes Bank recently, and that's showing good signs. We have seen growth with new customers coming in and existing customers. We are doing a lot of work to, in the coming years, increase our cross-sell. So that's where we're seeing growth.
All right. Let's also focus more on the financial part of it. Of course, we're also going to be talking about the new order win that you have to an extent of more than 150 crore, but that's for the later conversation. First, let's address your ESOP bit, where the expense in the FY24 in the ongoing financial year rather is expected to be around that 200 million rupees. What is the guidance going forward? What is the kind of cost that you're working with?
So if you look at our ESOP costs, Nickey, our ESOP costs were significant last year at about 14.5 crores. This year, our guidance is about 20 crores. And going forward, the next 2 years, FY25 and 26, it tapers down significantly. Our projections are in single digits there. So that's where we are. The bulk of the ESOP cost hit, so to say, is being taken in these 2 years, FY23 and 24.
So what are the projections essentially for the next financial year?
So that's about both next 2 years, it's about 12 crores.
Okay. All right. Let's also talk about your revenue in that case. There is a guidance which has come through for the company in the range of 20 to 30%. Help us understand that, because that seems to be substantially lower as compared to the base that you were working with. Of course, the size also is something that changes overall. The company has almost, in the past, if we were supposed to remember having a conversation with you at the time of IPO, where the company's revenue doubled to around 239 crore in FY21 to 553 crore in FY23. And now there is this cap that you're looking at, perhaps 20-30%. Is that the new normal? And what explains that?
Let me correct you there, Nickey. The guidance is 40 to 50%. That's what we have stated.
It's a little less than the previous year's growth profile, isn't it?
Well, you also alluded correctly that the base is larger, right? And we are also seeing, that the first 6 months of the year, right now we've raised the money, right? Essentially, so we're going to deploy that money now. But 40 to 50% is what we are projecting right now as a guidance, and we are very comfortable with that. I think it's healthy growth, and at a EBITDA margin or adjusted EBITDA margin of about 11 to 13%, we are very happy with that.
All right. Let's also talk about your revenue mix in that case. How will that shape up going forward with all the segments, something in the like of program fee, gift cards, SaaS fee, how the distribution will work out in this financial year, FY24, and what would change going forward?
See, SaaS revenues is growing well for us, although it's a relatively small number today, but it's growing very well, steadily. Similarly, program fees with the launch of our corporate credit card programs, with our market leadership in prepaid cards, we expect that to grow very healthily this year as well. And the Propel points, the gift card space, we are seeing tremendous traction there as well. So we are seeing a lot of traction coming in also, Nickey, because the market gives a certain credibility to a profitable fintech which is listed, and we are seeing the fruits of that come through. Where a lot of corporates, a lot of banks are showing a lot more comfort and eagerness to do larger type of programs and bigger programs with us.
Why don't we just put a number to that now, to those segments? Program fee contribution was around 30.6% in FY23. Gift card as a percent of your revenue was 65. Could you give us also the projection for the ongoing financial year? How can one look at it?
Nickey would refrain from that, would need to stick to what's the guidance that's been given to the market overall. I wouldn't be able to give you, those sort of guidances because
let's just ask differently. In that case, which segment will continue to occupy a major chunk? What changes?
No, the growth is in all the three lines of revenue, and you'll see
will continue to be the dominant one, right? I mean, that's where
the larger number. The larger number would be the gift card Propel points.
Okay. And between program fee and SaaS fee, where the prioritization will work more, where there will be more concentrated efforts?
Concentrated efforts are, see, the market pitch, or the effort is always to pitch a holistic solution. That's where we differentiate from a lot of other players in the market. Where we monetize 360 degree, we try to monetize across board. Because the reality of Indian enterprise and mid-market customers, Nickey, is that they're very clear. They want a high-quality solution, whether it's a software, whether it's a payment instrument, at a very reasonable cost. So we then need to work hard, be very innovative, use our, gray cells, and try to figure out how can we monetize. And that's what we constantly endeavor to do by trying to monetize through banks and networks and our merchant partners and of course our corporate customers.
Okay. Let's talk about your finance costs. You said that you expect it to come down. You expect it to come down substantially in the second half of the financial year. How does the number look like? What is the debt condition right now? And when is the company? Give us more light on the debt profile.
So we've already retired about 47 crores of our debt post the listing, Nickey, and our debt costs would come down significantly. The June quarter, the debt costs were about 4.4 crores, and it should come down by as much as 50%, and we should be somewhere in the range of 2.2, 2.25 crores.
All right. In that case, we'll leave it at that. Thank you so much for taking up the time and speaking with us.
Thank you so much, Nickey. Have a good day. Bye.
Right, with this, it's a wrap. Thank you so much for tuning in.